Now, on this Invest Talk podcast, Justin Klein listens to your questions.
Starting to learn more about value stocks rather than growth stocks. You guys are saving me a lot of money.
And provides unbiased answers.
All right. Well, you're looking at historical blue chip names, and they've endured. Their brands have endured.
Invest Talk. Over 42 million downloads and counting. Across America and around the world. Your participation makes it unique. 888-99-CHART.
At a time when investors are confronted with market volatility and a variety of challenges fueled by the uncertainty of inflation, unsettled geopolitical tensions, and economic pressures, Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. This is Invest Talk, independent thinking, shared success. Invest Talk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to Invest Talk. This is our Monday, June 6th, 2022 edition. I'm Justin Klein, and I'm excited to have this hour with you to answer your finance and investment questions. And I'm always careful to give you straight and unbiased answers each and every weekday. And no hidden agenda, just trying to give you the facts as I see them and perspective of over 20 plus years of investment experience. Now, this show will mainly be driven by your questions. I can talk about whatever's on my mind, but that's not what this show is for. Not to hear me talk. It's to hear your questions and give you the right perspective, the pros and the cons, the risks and the rewards. Okay? Now, if today's date, June 6th, sounds familiar, it should be. It was on this date, back in 1944, 78 years ago today, during World War II, the Allies began the so-called D-Day invasion that led to the defeat of Nazi Germany. For those of us who might have thought the brutal wars were a thing of the past, well, we have proof now that wars continue. Obviously, what's happening over in Ukraine. And one thing I can say for sure is that today's investment situation is very different from what we've had over the past few decades. And we have higher inflation now, and therefore we need to focus on the shifts in the markets and how it affects your portfolio. So it will be my goal to help you understand the current environment we're in and how to avoid pitfalls and capitalize on opportunities. And that is underrated. In good markets, investors tend to ignore the risks, and in rough markets, investors tend to ignore the opportunities. And it's your job as an investor to not fall prey to that emotion and be ready to head on a swivel, understanding that both risks come one side and opportunities come other side at all times. And you need to be ready. And that's what I'm here to help you do. So let's get right to our first listener question now.
Steve and Justin, I have a question on a stock that was recommended to me. The stock symbol is ZIM, Integrated Shipping Services. I've done my homework, and I'm looking at the fundamentals of the stock. Extremely high dividend, extremely low PE. Schwab gives it an A rating. The stock seems too good to be true. Can you give me a little insight on this stock? Is it a buy, or should I stay away? Or what is the good entry point? Anyways, I appreciate your guys' service. You guys do a fantastic job. Looking forward to hearing the response on your podcast. Thank you.
All right. Now, first off, don't ever make a buy or sell recommendation based on a Schwab rating or any just brokerage firm's rating. Okay. A lot of times there's conflicts of interest. They're typically, especially for a smaller name like this, they're typically run by some sort of algorithm. And it's based on current data around the company. And the problem is that the market looks forward. Okay, market is always investing through or pricing in the future. And you as an investor need to also be doing the same thing, looking through the windshield, investing through the windshield, not the rearview mirror. And for ZIM, this was a company that was losing money in 2019. And post-COVID, with shipping rates going sky high, they've made a lot of money. The problem is that shipping rates are coming down pretty rapidly. And earnings in 2021 are $38.60, supposed to be $42.77 this year, but going back down 64% is what expected for next year. So you're looking at that yield, and that's not going to be a yield that's going to be sustainable. Okay, so now they have made a lot of money, and the prices of the shares are only $67, but the technicals are starting to look fairly poor. It peaked out and gapped down back in the month of March, and it's rallied a little bit here from its lows in April, but still remains now in a downtrend. And I don't like the technicals. So I think this is a stock that's over earning. The shipping industry prices are coming down dramatically, and that means their profits are going to come down dramatically. So I do think this is too good to be true, and I would definitely pass on ZIM. Don't love the technicals or the trend of earnings. Thanks for the call. Now, my focus point today is based on this headline. 25% of Americans are delaying retirement due to inflation. BMO Harris Bank says that 36% of Americans have already seen their savings hit by inflation. And if you are in or nearing retirement, you will want to hear what other retirees are saying and what that could mean for strategy in the pre-retirement and retirement phase. And now, if we have time, I also want to touch a bit on the best stocks in an inflationary environment, looking at 10 sectors over the past 50 years and when inflation doubled over a short period of time, what stocks did well, or what industries did well, I should say that. And then also annuities. In times of market volatility, many people turn to annuities. In fact, annuity sales are up pretty significantly in 2020 and 2021. So we're going to look at that data and go over the pros and cons. And I know that sometimes they can be a little boring, but almost everybody's pitched an annuity at some time. So that you need to be aware of what they're good for and what they're not good for. And then lastly, I want to check in on the ARC funds and where money is flowing. Is money flowing into them? Is capitulation hit or not? And I'm waiting for that. I'm waiting for capitulation in the ARC kind of space, the ARC funds, and to tell me that the pessimism has reached a peak level. And we're going to check in on that data as well. But ultimately, I want to know what's on your mind. So give me a call, 888-99-CHART. Let's look at the market today. We had the S&P that was pretty much flat, up 12 points, about 1/3%. You had the NYSE that was up 51 points, 1/3%. The NASDAQ, what do we get? 48 points, a little bit better there. Overall, just kind of a very, very modest up day. Still kind of in this bear market rally that I think still has a little bit room to run on the upside. Now, is it going to be dramatic? Probably not, but you are getting a bit of a float here as the market still is battling with what is the pace of Fed policy, what happens beyond the July meeting. We have a meeting this month as well as next month, and what those rate changes will do to the markets, to the economy, and will the Fed continue on with that? And I think that's something the market's still kind of battling with that particular process. So that was the market today. Pretty modest move to the upside. Interest rates were up a little bit. The 10-year did hit. What did it hit today? Yeah, 8 basis points, pretty decent move, back above 3% on the 10-year. And I do think we're kind of in this consolidation phase within the 10-year, kind of in this high 2s, low 3 range until there's some resolution to what the pace of policy will be going forward. Now we're moving into a break. My Invest Talk phone lines are open for you at 888-99-CHART.
Why do listener questions make Invest Talk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that Invest Talk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call Invest Talk, 888-99-CHART.
One of the most rewarding things I do each weekday is host the Invest Talk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each Invest Talk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Hey, Justin, it's Jeff calling from the East Coast, Maine. Hope you're doing well. Just listening to your show this morning. Just had to ask, if you're not a LeBron fan, I mean, I'm an NBA guy. I was a Kobe guy. Not really a LeBron fan, but you mentioned about the different eras and you left LeBron James off. So I just wanted to pick your brain about that. And then I also just wanted to hear your take on the stock IDEXX Laboratories, ticker IDXX, company headquartered here in Maine, provides services for veterinarians, and might be looking to buy it, but just wanted to get your take on that stock. Thanks for the show. Love it. And look forward to hearing your response.
Well, great comment on LeBron. I definitely left him out, and I thought about that later. I said I should have said LeBron because there's definitely a very long LeBron era, and he's definitely one of a kind. I'm a Laker fan, so obviously have to support him. But yes, that was or is, if you consider him still in his prime, the LeBron era. But hopefully I didn't offend anybody leaving out LeBron. But getting to IDEXX Laboratories, they develop and manufacture diagnostic products and services for the veterinary market. So basically a pharma company for pets and horses of many kinds. So this is a company that's been growing consistently, and I like that they are a consistent grower. Earnings in 2019 were about $5 a share, $6.25 in 2020, $8.17 last year, and expected to only increase earnings about 1% this year, although earnings expectations are coming down. Now, the issue here is just the multiple that it's trading at. It was one of those secular growers. It was I call it a hedge fund hotel, where every hedge fund was getting into it and it created a lot of momentum, and the valuation just got absolutely out of control. Enterprise value to EBITDA back in August of last year was at 60, which is just an absurd number. It's now been cut in half to 31, but that's still relatively high. So I just don't think it's quite cheap enough yet. Its free cash flow trailing 12 months is about $600 million, although that is down. That looks like it is in decline a bit. They have a decent amount of debt that I don't love. They are buying back shares, not aggressively, but consistently, which I like. But it looks like they were doing that at a pretty high price back in, as the valuations were very high, which I don't love. Technicals, let's look at the technicals, because this is one of those companies that you want to have in your watch list just because the business is so good. It's a consistent business, high return equity, high cash flow, etc. But you need to pay at least a reasonable price. And now I still think it's probably 20 to 30% overvalued. It is at support, but I think there's still probably more room to run on the downside, especially if you look at the technicals. it's pretty ugly. And it's not really showing any signs that it's going to turn anytime soon. So there is some support here around 350. Now it's at 372, so it has bounced off of support. My price would be around 270. Around 270, about $100 per share lower than it is today. That's when I would get interested in this name. But not until then, because I think the growth continues to slow. Revenue only up 8% last quarter. Earnings up 3% year over year last quarter. Trading at 40 times forward earnings. Not exactly cheap in my book. So good to have in your watch list, but needs to be at 270, not 370. Now we're moving into a break, but after the break, I want to touch a bit on inflation and inflation in relation to retirement. And this is a new era, and that means retirees have to think about risks of both the downside as well as the upside, meaning most retirees are only considering they don't want to lose money nominally. But in an inflationary era, you can lose money through inflation, right? And losing your purchasing power. And so we're going to talk about that after the break. So I want to hear from you. I'm ready to take your questions now at 888-99-CHART.
Each day, Invest Talk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for Invest Talk at iTunes. And be sure to include a brief question with your iTunes review comments.
Let's go to Will in San Diego looking at Cleveland Cliffs.
Yes, Justin. Thank you for all your service. This stock hasn't gone anywhere, so I'm wondering, is it something I should hold on to or get rid of?
Well, Cleveland Cliffs, they are a producer of flat-rolled steel and a supplier of iron ore pellets here in the U.S., and it's been kind of going sideways, definitely underperforming the commodity index as a whole. Did you say you own it or you're looking to buy it?
No, I've owned it for a while, and it's steadily gone down.
Okay. Well, when you say a while, is that a month, 2 months? Because it's not that far off its 2-week high.
Yeah, I bought it probably somewhere in the low 30s.
Okay. So this is about a month ago. Or two.
No, excuse me. No, I bought it before that. I'm down about 2%. I bought it about $26.
Okay. Well, now it's at 23.
About a year ago.
About a year. Yeah. Okay. Interesting. Oh, gotcha. Okay. So, it surged earlier this year and then has had a pullback, but the technicals are fine, to be honest with you. The fundamentals are fine. I like the space as a whole. Now, it's not my favorite steel company out there. Let's just say that. So I would be looking to switch into something in the same space because I like steel right now, especially with what's happening in global deglobalization, more probably infrastructure spending here, more industrialization here in the U.S. And so a lot of the domestic producers I like, but Cleveland Cliffs historically is not one of the better ones. So I would sell it, but switch it out for something within the space that's a better performer longer term. Thanks for the call.
Great. Thank you.
No problem. Now, before the break, I touched a bit on retirees and how inflation is affecting them. And currently, CPI is around a little over 8%. And this is hitting the lifestyle choices of many retirees. And a full quarter of workers are now postponing their retirement as inflation forces more and more Americans to dip into their savings. Now, this is a report by BMO Harris Bank. They found that 36% of Americans have already seen their savings hit by inflation in some way. And it found that older Americans are on the verge of retirement are feeling the crunch even more. And this has impacted their planning, their budgeting, their dining out less, shopping less, driving their cars less. Now, 1 in 10 Gen Xers or boomers who are also nearing retirement age have already delayed leaving the workforce or are considering doing so. And that's according to Nationwide Insurance. So there's multiple surveys that are talking about these Americans. Now, only 22% of Americans this year feel they have enough saved for a comfortable retirement. That's down from 26% last year. And this was conducted now in February, so it is a little old, but it just shows you that trend. Now, more than half of the respondents in that survey said that they expect to have less than $500,000 in savings by the time they retire. And that's drastically below the average retiree, which has $1.1 million as their ideal retirement fund. Okay. Now, the main concerns of those hopeful retirees are inflation, and they're worried that the rise in the stock market may reverse and change their assets in a big way. And that's the struggle that retirees are dealing with right now. It's something that historically they haven't had to think about since really the 70s. And that is inflation devaluing their savings and their real returns turning negative. Remember, real returns are backing out inflation. Now, for the past 30, 40 years with globalization, inflation rate of 1% to 2%, not a whole lot, not enough to really consider. It was more about how do I grow and protect the assets, right, to the downside. And you had the big dot-com crash, you had the housing market crash, the financial crisis, and that's what most people think about when it comes to planning for retirement, is how do I protect the principal of the asset? But now it is a shift. It is a shift in battling two fronts, battling two risks. And I think that makes it even more challenging than typical. It's how do you take advantage of the positive returns that inflation brings. Remember, inflation in certain parts of the market is actually good for stocks. Not all, but many sectors, which we'll talk about in a little bit. And you need to take advantage of that, because sitting in cash at 1%, 2% is going to eat away your returns. Even in low yielding bonds, even treasuries, right now 3%. You still have negative returns. And that is the battle that most retirees are trying to deal with, and that's what we're trying to help you with as well. Now, we're going into a break. On the next Invest Talk, the story behind this headline: once the China backlog clears, Europe and the US might see a rush of shipments. That story tomorrow, but for now, I'm taking your calls live at 888-99-CHART.
Have you heard about Shopify? You should. Shopify is the all-in-one commerce platform that you can use to start, run, and grow your business. Shopify is designed for anyone to sell anywhere, giving entrepreneurs the resources once exclusively reserved for big business. You can customize Shopify for your particular business needs. Shopify provides a great-looking online store that brings your ideas to life with easy access to the tools to manage your day-to-day operations and drive sales. With Shopify, you can get started by building and customizing your online store without the need for coding or design experience. Shopify has thousands of integrations and third-party apps, from on-demand printing to accounting to advanced chatbots and beyond. Shopify instantly lets you accept all major payment methods. Plus, with 24/7 support, you're never alone. More than a store, Shopify grows with you. Are you ready to take your dream to the next level? Go to shopify.com/invest, all lowercase, and get full access to Shopify's entire suite of features. Start selling on Shopify today. Go to shopify.com/invest right now. Shopify.com/invest.
In today's complex, fast-paced world, you need a partner who can help secure your digital transformation so you can drive your business forward fearlessly. Enter Entrust. With Entrust, you can enable trusted experiences like mobile identities, multi-cloud, digital payments, hybrid work, and beyond. They have a wide portfolio of the solutions you need to help secure your digital transformation and accelerate your organization's growth. Entrust, securing a world in motion. Learn more at entrust.com/podcast.
Invest Talk is always made better when our listeners contribute their questions. So tell your friends and family members they can interact in real time with Steve Peasley and Justin Klein during the Invest Talk live stream program between 4 and 5 p.m. Pacific Time. Or they can leave their questions anytime, 24/7 in the Invest Talk voice bank. 888-99-CHART.
Hey guys, thanks for everything you do. I just wanted to call and say thank you. I talked to Justin about 6 months ago and about Camping World, and he advised me to not go in there, and I did it, and Camping World's down pretty big since then. So thank you. I'm calling today about Nelnet, NNI. Just kind of want to see what your thoughts are about them. They service, the big bulk of their revenue comes from student loans. They do service student loans. And if Biden forgives student loans, and they should be getting a big chunk of that in one check, which is a big portion of their book value. So I was just wondering, they have a good record of growing book value, 17% over their lifetime. So just wanted to hear your thoughts, and if now is a good buy point or not. Thank you. Bye.
All right, this is Nelnet, and they hold student loans and engage in student loan servicing and tuition payment processing. The majority of the company's revenue is interest income from student loans the company holds. So I think the answer to your question is the exact opposite. Yeah, they might be getting payment, but that means they're missing out on interest. If their profits are coming from interest and the government's going to pay off those student loans, guess what? Yes, they might get the principal, but that principal wasn't in jeopardy anyway. Remember, they're government backed. So what they make money on is those loans being outstanding and accruing interest, and them servicing those loans and getting fees as well. So I actually think this would be bad for the company. And if you look at the earnings expectations, they're coming down pretty significantly. 2020, $11.46 in earnings. 2021, $8.37. 2022, $7.05, expected down 16%. And then next year, $6.15, down another 13%. So, I don't love this. Now, I don't know if there's actually going to be student loan forgiveness or anything like that, but it doesn't seem like something that is going to benefit this company, because, like I said, the majority of their profits come from interest. So, unless I'm understanding this wrong, this is not a name that I would be interested in. Thanks for the call. Now, let's touch on what stocks tend to do well during inflationary environment. And this is a great study. And what they did was they looked over the last 50 years and they try to find periods where the CPI spiked significantly over a short period of time. And there were 3 periods where inflation doubled in less than 24 months. That was March 1973 to May 1975. April 1978 to September 1980, and February 21 to March 2022. And they looked at 10 different sectors and looked at the average, the median return for those different sectors. Now, most people would say, well, inflation is good for real estate prices, and that's going to be a good place to be, right? A hard asset. And the answer is actually, it's okay, but it's certainly not the best. What are the best? Energy, 18%. Materials, 16.8%. Financials, 5%. Industrials, about 3.4%. And real estate, 3.3%. Those were the sectors that were positive during those periods of time. Then there were 5 sectors that were negative. The worst sector, healthcare, down 8.4%. Consumer staples, down 6.7%. Consumer discretionary, 5.7% negative. Utilities, down 4%. And tech, down 3.64%. Now you're going to say, well, during rough times, you would think things like staples, utilities, those would go up. The problem is that their input costs for utilities and consumer staples tend to go up, and that squeezes their margins. And that's why those tend to struggle. Now, that hasn't happened with utilities lately, has happened to staples, but that was an interesting little tidbit there. Now, the other 3 sectors that were negative, tech, consumer discretionary, and healthcare, all interest rate sensitive. We've talked about tech many times. Growth companies, high multiples, those come down. That's clear. Consumer discretionary, if it's harder to borrow, harder to take money out of your house, harder to borrow, more expensive to borrow on your credit card, etc., you're going to spend less money. And then healthcare. A lot of those companies tend to pay consistent dividends, and they're kind of bond proxies in a way. And you could say the same for utilities. So all of those, it makes sense why these are the sectors that struggle in an inflationary environment. Now, financials do pretty well. Higher interest rates means easier to pay, more profitable to lend, and also inflation in general, prices across the economy going up means people are, maybe they're earning smaller margin, right? Companies might be, but their overall profits tend to go up. It makes it easier to pay back loans, etc. So multiple factors that drive positive dynamics for financials. And then industrials, that's pretty clear. Companies are trying to invest in their business to make it more efficient, etc. And that often means more industrial spending, more industry is needed to extract energy and materials out of the ground. And so those sectors tend to do well as well. Now, real estate, I think the reason it doesn't do quite as well is because it's interest rate sensitive. Yes, overall inflation tends to be good for real estate, but higher interest rates are actually a negative. So that's why it's kind of barely positive. So I thought that was a really interesting study and something I kind of knew, but it's always good to get the data and understand what the median performance is over those time periods. Now let's go to the Invest Talk voice bank for a question that came in earlier from New Jersey.
Hi guys, this is Brett from New Jersey. Thank you again for all that you guys do. I had a question about my Roth IRA contributions. I was looking for something that I could just kind of put in and forget about and not watch all the time. So I've been splitting 1/3 into the following ETFs: VTV, Vanguard Total Value; VOO, Vanguard S&P 500; and VYM, the Vanguard High Dividend ETF. I like these. I think they're solid, but I was wondering if I'm missing out on some small cap value, small cap growth. Is that something I should be interested in and try and go a quarter of each, try and catch the small cap up to my other ones? It's only been about a year and a half of contributions, so looking forward to your answer. Thank you very much. Bye-bye.
I think you're definitely on the right track here, because if you look at Vanguard Value ETF as well as the Vanguard High Dividend Yield ETF, there's going to be a lot of overlap with the S&P. Why? Because they're all larger cap ETFs. And so you're going to, to me, there's a little bit too much overlap. And if you're looking longer term, smaller cap companies have better returns. So you're going to want to have more exposure, or at least some exposure, to smaller cap names. So a small cap value ETF, I would replace that with the S&P one, because you're already getting, 2 value focused funds with the Vanguard Value as well as the Vanguard High Yield ETF. I would probably add in a small cap and also lean on the value side, but much smaller, and longer term, you're definitely going to get, I don't say definitely, likely to get better returns. Thanks for the call. Now, summer is almost here, almost about 15 days away, and you're seeing the market rebound a little bit, but volatility is still here. And the summer is typically a time where volatility tends to pick up, and we're still in a upwardly trending volatility environment, which means that despite the market calm right now, you're likely to see some level of volatility throughout the summer and maybe into the fall. And that means you need to pay attention. You need to understand the risks that you're taking in your portfolio and whether it's set up to buck the trend, or are you just going to slide down the hill with everybody else? So if you aren't sure, I encourage you to reach out to myself or Steve Peasley at our company KPP Financial, where we practice parallel investing and we implement unbiased guidance both on and off air. So you can take advantage of our free portfolio review assessment via telephone or GoToMeeting by sending us a message through investtalk.com or calling our office in Irvine, California at 800-557-5461. We'd love to speak to you just a short period of time and help you in any way possible. The sooner you contact us, the sooner we can help you get your portfolio optimized. Now, we will squeeze in another Invest Talk caller question next, so hang on.
Each day, Invest Talk listeners submit their finance and investment questions via phone or email. And Steve and Justin thank you for your loyalty. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for Invest Talk at iTunes. And be sure to include a brief question with your iTunes review comments. Your rating is a vote of confidence that leads to higher visibility and causes more people to discover and listen to Invest Talk. So please tell your friends and family members about the free Invest Talk downloads at iTunes, Spotify, Google Play, and investtalk.com. Remember to include your brief question when you review and rate on iTunes. And of course, your calls are always welcome 24/7. Don't forget to call Invest Talk, 888-99-CHART.
Hi, Steve and Justin. This is Derek from Johnstown, Pennsylvania. And I'm calling in regards to Exxon Mobil, XOM. I wanted to find out what your target price is for this particular stock. I was able to get in at $33 through your recommendation, so thank you very much for that. And given the price gains, I wanted to find out whether I should taper some, sell, or hold. Thank you very much, and looking forward to the show. Bye now.
All right. Well, Exxon, I will say, has gotten slightly above our target currently. Right now, it's trading on $99 per share. Not to say that it can't go higher. Our energy policy globally is pretty bad, and it's only going to drive energy prices higher over the long term. Now, near term, you've definitely had a pretty strong surge in the energy stocks, and they're pretty overbought. So I think it depends really on what your allocation is to the energy space. Are you over-allocated, under-allocated? Exxon is kind of the bellwether within the space. Well diversified, has oil, natural gas, has downstream operations as well, refining, etc. And right now is probably one of the best times in Exxon's history of its operations. So, and I don't see that environment changing too dramatically over the next number of years, because just the industry in general is not ramping up production. It's not really having the supply response that typically you have within the industry when prices are high. You've seen that with the rig count and just production, both here domestically and globally. And then the supply issue, the demand destruction is not quite there either. I mean, people don't love gas prices at $5, $6 a gallon, but inflation adjusted, it's not really much higher than it was back in 07, 08. And then you have governments that are talking about subsidizing the prices, which means less reason for people to stop using. So, is it fairly valued now after this big run? Probably now it is. Does that preclude it from going higher if oil prices continue to go up? Absolutely not. And as oil prices go up, you have to raise your target. So I wouldn't look at it here and say, oh, I need to trim it. I would look at it and say, what is my overall exposure to the oil space? And which ones might be beyond a realistic valuation? And I would say Exxon isn't high on that list. It's kind of probably where it should be. So it's definitely not a strong sell. It's at the minimum a hold right now. Now we can squeeze in a short question, so let's try now.
Hi, Andrew from New Hampshire. Thank you for your show. I have a question about your updated view on Big Lots. Capital BIG is the symbol. It's down quite a bit since you were last asked about it, and I appreciate an updated view from you about that. Thanks. Take care.
All right, this is Big Lots, and they had an earnings report, and they lost money for the first time in a while. And this is kind of common within the space right now, over too much inventory. And, it's going to take probably a quarter or two for them to work through the inventory and all that, but it's still long-term based on its earnings power. And it typically earns $3, $4 per share. It's at $24 right now. So it's extremely cheap buying back shares. I still think longer term, it is very, very cheap at these levels. I'm Justin Klein. This concludes another Invest Talk program. Steve Peasley and I thank you for listening. We encourage you to tell your friends and family about our free podcast download. Oh, actually, never mind. This isn't the end. We're just going into our final break. We have one more segment left, so give me a call, 888-99-CHART.
In today's market, more than ever, you need unbiased investing guidance because it can help you achieve financial freedom. This is Invest Talk, and you've come to the right place. Justin Klein is here now, taking your calls live. So step up with your questions, 888-99-CHART.
Steve and Justin, thanks for the show. This is Art from Tucson. I am calling about a small cap industrial, Mueller Industries, MLI, and wonder what you think a good entry point would be for a longer term hold. And I'll be listening on the podcast. Thank you. Bye.
All right, looking at Mueller Industries. Interesting name here. Consistent cash flow, consistent profitability, return on equity over the last decades averaged probably high teens, low 20s. And I like that. I like that consistency of the business. They're not issuing a bunch of shares at the same share count as they did back in 2014. They're not buying back shares, but they're paying a consistent dividend. That dividend has grown from 21 cents in 2012 to 64 cents per share now. So I like that. I like their business. What they do is they make copper tubing, copper, brass, aluminum, and plastic products, mainly piping systems, industrial metals, and climate tubing. So I'm a fan of this company overall. Now, let's look at the chart and see what the trends are saying in the near term. And they're pretty positive. It's been consolidating. It had a big surge back in October of last year and has now been trading between 50 and the low 60s ever since, and just consolidating in a wide range. And it hit the 200-day moving average last month, and it's exploding higher. So I'm going to give Mueller Industries a thumbs up. I like that's industrial space. I like the consistency of its business. It's not expensive. It's trading at about a 10% free cash flow yield, although earnings are expected to come down a bit over the next couple of years. So I think the P ratio is currently maybe a bit too low, meaning that it's typically is going to trade in the low teens to mid-teens on the P ratio. I think that's fine. So the chart looks fine. The business looks good. The dividend is nice, 1.7% yield, not crazy high, but it's growing. And this is a good example of the type of business that does well longer term. It doesn't pay the highest dividend, but it's growing the dividend. And that's far more important than, the company that just pays a big 5, 6, 7% dividend today. I rather own the 1.7% dividend payer that's growing that dividend consistently, and it's a smaller cap name. It has cash flow. It has profitability to continue to pay and grow that dividend. So I'm a big fan of this name. MLI is the symbol, Mueller Industries. Thanks for the call. Now, lastly, I want to touch a bit on annuities, because annuity sales are up and they're at the highest level since 2008. Ring a bell? And when there's market and economic volatility, annuity sales go up. Last year, $255 billion of annuities were sold. That was up 16% from 2020. And in the first quarter of this year, annuity sales were $64 billion, up 4% from the same period last year. But most people don't know what annuities are exactly, the pitfalls, and the risk and the costs. Well, one thing you have to understand is annuity is just a contract. It's an insurance contract. And you either get an upfront lump sum payment, and you give an upfront lump sum payment, and that guarantees you income stream for life for a fixed period of time. And there are various types. There are fixed annuities, and those are typically probably the only ones you really want. There are variable annuities that allow you to make investments in mutual funds, ETFs, etc. Those are typically the worst because they have the highest fees. And then there's index annuities that are tied to a particular index. Typically the S&P 500 is a common one. But one thing you don't realize about those index annuities is that dividends are not included in those total returns. And the whole selling point is you don't have downside. And you can add riders to kind of adjust the way these things work, but that just adds fees. And it's just a contract. And so in times of stress, market volatility, people want certainty. But the certainty is over the long term, you're going to do much better as an investment outside of an annuity. Annuities are very poor investments. Now, for particular purposes, fixed annuities can be good for the right reason. But remember, if you have Social Security, that's basically a fixed annuity. So do you need another one on top of that? Probably not. So understand that about annuities, that they're typically very high fees. The person selling it to you gets a huge commission, so they're going to tell you all about the great things. They're not going to tell you about those fees. Well, that does it for today. I'm Justin Klein. This completes another Invest Talk program. Steve Peasley and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Independent thinking, shared success. This is Invest Talk. Good night.
Invest Talk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. Invest Talk is a copyrighted program of Klein, Pavlis, and Peasley Financial.